Assalamu alaikum. Welcome to lecture 5 of ATX. So, in my previous lecture, I have discussed when you are closing down the business and also when you are transferring your business to a company, what are the implications on the tax? And we have studied a new relief known as incorporation relief. Now, from there, we are moving on to partnership income. Remember, partnership is also a form of unincorporated form, like sole trader. So we have finished the sole trader. Now we are moving on to partnership. Both of them falls under unincorporated. Okay, this is a very short lecture, and the way most of the things like how you assess the profit, the period when you are going to tax the partnership profit are similar to your sole trader. So make sure that you watch lecture 3 and 4 for a better understanding of lecture 5. So coming on to lecture 5. Here we are going to focus on trading income assessment for partners, partnership trading losses, partnership capital gain tax. This aspect is new in ATX and summary. So now the overview of this lecture. First we are going to finish the income tax part, trading profit, how you calculate the trading profit in partnership and trading losses. Then CGT when you are selling your partnership asset. For tax purpose, all partners are treated as their own right. That means all partners are treated as sole trader who are running their own business. That means, let's say in a partnership, you might be having 5 partners. All the 5 partners will be treated separately. They'll be treated as 5 separate sole traders when we are taxing them. Now, you have to tax each partner individually on their share of profit and loss. Okay, profit and capital gain. And each of the partners are responsible for paying their income tax, their NIC, and their CGT. Now, partnership adjusted profit. This is exactly the same as for a sole trader, the tax adjusted trading profit. Okay, so the accounting net profit is adjusted for disallowable expenditure, non-trading income, etc. in the normal way. What is this disallowable expenditure? What are these non-trading income? I have covered in lecture 3. Very well. So please do go watch my lecture 3 because there I have started the types of income for a sole trader. Okay, I'm not going to repeat it here, but it's just the same, the way you calculate the accounting net profit. Now, even in sole trader, we have capital allowances. So here also, each partner will be applicable for a capital allowances. It will be calculated in the normal way, starting with tax adjusted, tax written down value, then AIA, FOIA. So that capital allowance you will deduct from your tax adjusted profit. And note that partners salary and interest on capital, they are charged through statement of profit and loss. Okay, they come in the profit and loss. That's why they are not allowable deductions, because they are not allowable deductions and you have deducted it. See, already you have deducted partner's salary and interest on capital to arrive at net profit, accounting net profit. That's why, but they are not allowable deductions for the purpose of tax. That's why you need to add them back, because they are not allowable. Anything which are not allowable deductions, which has been deducted, you have to add back. Same like depreciation. So now you need to add back. Why? Because they are an appropriation of profit. That's the way you're taking out the profit in a form of salary or interest on capital. You are saying they are not expenses, allowable expenses. That's why you're adding it back, because they are not an expense of the business. Capital allowances can be claimed on assets owned personally by the partners. If they are used in the partnership, if the partners are using the asset for their own personal use, you can't claim capital allowance. Only that asset needs to be used in the partnership. Okay, but individual partners cannot claim the capital allowances on their own behalf. Okay, and remember, capital allowances are an allowable expense against the partnership profit as a whole. So from the partnership profit, yes, you can deduct capital allowance. Anything allowable means you can deduct, not allowable, disallowable means can't deduct. Now, profits are allocated. This is how it is done. Either in the profit sharing arrangements, most of the partnerships might be having some form of a agreement that how they are going to share the profit. Okay, which are during the accounting period in which the profits are earned. Once the partners have been allocated their share, Then each partner is taxed on his or her own share of the account, trading profit. Remember, first you calculate one trading profit, then you allocate it among the partners. Then only will be taxing. Okay, this all the way you share, the way you calculate the trading profit according to the basis of assessment rule are same for the sole trader. That's why you need to go to my sole trader lecture and my lecture 3. Now, profit sharing arrangements. There's a combination of three types of allocation. Three ways you can allocate. Number one, salaries. Either you can give each of them a fixed proportion, which this is a fixed proportion of profit. From a profit you are saying you are giving them a fixed salary. Next way you could allocate is interest on capital introduced into the business. A fixed percentage based on your capital. Then profit sharing ratio. Each of you must have agreed to a ratio. Okay. Now, remember, terms salaries and interest are just an allocation of profit. They are not expenses. Okay. Therefore, they are not assessed to income tax as employment income or savings income. This is very important. Normally, what do we do? Salary, we take it in income tax as an employment income. Right? Interest comes as a saving income. We pay income tax on it. But here, interest and salary, they're just an allocation of profit. They're not assessed to income tax as employment or savings income. Whatever terms are used to describe the allocation method, whether it is salary, interest on capital, or profit sharing ratio, the total amount, remember, allocated to each partner will be assessed to income tax as trading income. Okay? Each partner has to pay income tax on their, it's a trading income for them. They have to pay income tax on it. Okay? Now let's do a question. Test your understanding one. So two people formed a partnership. They agreed to share their profit equally. Interest is of 10%. Charging interest of 10% on their fixed capital, which is 8,000 and 5,000. Paying a salary to only one partner of 5,000. Tax adjusted trading profit were 15,000. Show the allocation of profit. See, in your ATX exam, they will not ask you this simple question, okay? But this is just a beginning and it's like a revision for you to understand how you allocate the profit. So first, we are going to write the name of the two partners. One is Highwell. The other one is High1. And the other category is total. Okay, so interest on capital. We are going to write interest on capital. Interest on capital is 10% on their 10% on the amount 8,000 and 5,000, right? So 10% that is 800 and 500. 800 for Highwell, 500 for Highwell. Total is 1,300. Now salary. Salary only one partner is giving. Highwell is getting 5,000. This is null, nil. Okay, so the total is 5,000. Then the balance is shared. This is a balancing figure, okay? Allocation of profit. They have already given a tax adjust of 15,000. Allocation of profit total is 15,000. They told it is divided equally. This is now. So the balance is shared equally. See, how do you start this? This is the starting place because we know this two and we know this one. So just find the balancing figure and this needs to be divided equally among these two. So 1,300 plus 5,000 and deducted from 15,000, it will be 8,700. This 8,700 divide equally between high one and high one, which will be 4,350. 4,350 and 4,350. Now add up and see. This will be 10,150 and 4,850. Add this together and you should be getting 15,000. Change to profit sharing agreement. Previously we went through allocation. Now it is changed to profit sharing. So when you're changing it, there are many ways. Maybe existing partners may decide to allocate profits in a different way. For example, they might change the duty, they might change the senior junior people, okay? Or the membership of the partnership may change. Maybe someone, a new partner gets into the partnership, or they die, or a partner retires from the partnership. So when there is a change in profit sharing ratio during the accounting period, this is what happens. The accounting period has to be time apportioned in two or more parts, depending on the number of changes. And each part is then allocated separately between the partners, according to the partnership agreement in place at that time. Let us do a small question regarding to this change to profit sharing agreement. Test understanding 2. Here you have to show the allocation of profits between partners for the 3 accounting periods. Okay, but there have been some changes to it. So we'll see. Xavier and Yon started in partnership on 1st of Jan 2022, sharing profits equally. And there is a salary also to Yon of 10,000. From 1st of July 2023, Zach was admitted as a new partner. Profits are shared equally, but with no salary. On 30th September 2024, Xavier returned from the partnership. So Yoon and Zach agreed to share the profits in the ratio of 3:2. And you have been given the tax adjusted trading profit for 3 accounting periods. Okay. So there has been more than one changes in different accounting periods. Okay. You have to work in a chronological order. Even that I've started first, you have to work with that. So let us do that. Okay. So we are going to make 4 columns and with the total. So let us quickly do that. First we have Xavier X, then Yon, then Zach, then we'll write the total here. No problem. Okay, we'll just write the total here. Salary and balance shared 1:1. There were 2 partners in the beginning, and wait a minute, whenever they ask you for more than one period, always write the accounting period. So the first one will be year ended 31st December 2022. Okay, so that time we only had a salary of 10,000 for Yoon, nothing else, and everything else is shared, and profit is 50,000. So the total, so he's getting a 0 salary, he's getting 10,000, 0, and total is 10,000, and you have been given the total, which is 50,000. The balancing figure go back like this, 40,000, and this 40,000 is shared equally between Xavier and Yoon, X and Y only. Remember, Z is a new partner, he came later. In this accounting year he was not there, so it's 20,000, 20,000. So this is 20,000, 30,000, 0, and 20, 30 makes 50. Coming to the next accounting year, Year ended 31st December 23. Even this is broken down into two periods. Why? In the middle way, 1st of July he went. So for 6 months, there were no change. Okay, that means from 1st of Jan 23 to 30th June 23. There's been no change. Still, we'll be having the salary. You will be having salary. See, from 1st of July only there are no salary allowance. But before that, from 1st of Jan to 30th June, there's a salary still. Okay. And here, this salary is 10,000. It's per annum. But since this is only for 6 months, salary will be divided by 2. It's a half of it. So 5,000 salary you will get. Okay. So 0, 5,000, 0, and the total is 5,000. The salary. Okay. Now the balance is shared. So what is this thing you are given? The balance sheet will be this as it is. This one same as it is. This one only. Here, remember, this is 90,000. This 90,000 needs to be broken down into 245,000 because it's only for 6 months now. From Jan to June, it will be 45, and from July to December, it's 45. 45, 45 makes 90. So this time, it will be 45,000 here. So here, the balance, 40,000. This 40,000 will be divided equally, 20,000, 20,000, and 0. So here 20,000, right? So don't write here anything, just keep like this because this is in the half year. Now another period, 1st of July 23 to 31st December 23. No salary this time, only you will share the balance. So the balance will be shared equally among the three. What is it? Still this is 45,000 because this 45, 45 makes 90. So it's 15,000, 15,000, and 15,000. Now Zach is also there. Jack came from 1st of July. That's why it's 3. So together if you see 45 and 45, add from the total is more easier, 90,000. This is 15, right? So this you need to add to this. This needs to be added here. This needs to be added here. So it's 20 and 15, 35,000. Okay. 20 and 15. 25 and 15, 40,000. And here just 15,000. If you add this also, you should be getting 90,000. Now the last one. Year ended 31st December 24. When did he leave? 30th September. So from 1st of Jan to 30, this date, 30th September, Xavier was there. Xavier left after that. That means for 9 months. You have to take the profit of 9 months. 1st Jan 24 to 30th September 24. How many months? 9 months. Balance will be shared 1:1:1. Remember, Xavier is still there. And then another period runs from 1st of October 24 to 31st December 24. This time balance will be 3:2. Now 2 partners. Okay. So you need to do, you need to break down this. This profit has been given 150 annually. Take it only for 9 months. It will be 112,500. This is the total. So the total is 112,500. Divide this by 3 equally among the 3. 37,500, 37,500, 37,500. Now Xavier left 30th September. So what is it? Here it will be 37,500. Why? The total has to be 150,000. This needs to be divided in 3:2. Now Xavier is no longer there. How you will divide it? 37,500. If you see the total, it's 5 into 3 for the portion of Yon. And for the portion of Zach, you multiply this by 2. Okay. So here it will be 22,500 and 15,000. You'll get the 37,500. And then you add. Remember, Xavier is no longer there. He was there only till this 9 months. So 37,500, and here add this 2 and add this 2. It would be 60,000 and 52,500. That's it. So after changing in the profit sharing, next is calculation of taxable trading income for each partner. Okay. The partners are taxed on their share of profit share as if they were the sole trader who runs a business. Okay. Starts when they join the partnership. Remember, you start calculating their taxable trading income from the day they start the partnership and till the date when they leave the partnership. It ceases when they leave the partnership and has the same accounting period as the partnership. The basis of assessment rule determines in which tax year the adjusted trading profit will be taxed. Okay. See, there has been some changes going on to the basis period rule. So it has been changed from the current year basis to the tax year basis. So the ATX examining team has confirmed that your exam, the exams from 1st of June 2024 to 31st March 25, okay, they will be using the tax year basis. So unincorporated businesses, okay, in your ATX exam, they made it easier for you because your period is a transition period. You don't have to work on it. So they will give you an accounting period in such a way that it always ends on 5th April or 31st March. Okay. Where you are required to calculate accessible profit for a tax year because your tax year also ends at that date. If it's a company, it will end on 31st March. And for individual is 6th to 5th April. Okay. So some questions may involve an unincorporated business which does not have an accounting period ending on 5th and 31st March. Right? Early we had this issue. That's why we had this basis period. But in this case, you don't have to calculate. Examiner will give you the taxable trading profit for the relevant tax year. From this year onwards, okay, this year, the current year opening and closing year rule, where you used to have overlap profit before, it will not be tested from you. If a question involves commencement or cessation of an unincorporated business, taxable trading profit for the relevant tax year will be provided. So when you're commencing and when you're ceasing, they will give you the taxable trading profit for that period. Do watch my lecture 3 and 4 where I went through the commencement and cessation of unincorporated business. Now, calculation and allocation of partnership trading loss. What if it's a trading loss? It is same principle you have to use when you are calculating profit. So each partner is allocated a share of the tax adjusted trading loss, including capital losses, according to the partnership agreement, exactly same way as profit. Now, what are the loss relief options? See, for sole trader, in my both lecture 3 and 4, there were lots of options. Carry forward, carry back, terminal loss relief, incorporation relief, carry against chargeable gain, against trading income, against all income. But what about partnership? Remember, each partner is treated as a sole trader. Therefore, they can utilize their share or her share of the partnership loss under the normal trading loss rules. That's why you need to watch my lecture 3 and 4. You have to know what are these trading loss reliefs. It's explained there in detail. Same thing will be applicable here. Whether the only thing is now this is a partnership. That is the only thing that has changed. Everything else remains the same. In the most tax efficient manner, you have to choose the reliefs according to the partner's own personal circumstances. Yeah, sometimes you can't go for a certain relief based on his or her circumstances. Now, these are the loss relief options available. I've made it very easier for you. This is a summary of what are the reliefs available at each stage. So, when a partner joins, there is a separate type of relief. For an ongoing partners, there are another set of reliefs, and for partner leaving, there are some other reliefs. But some reliefs will be applicable for all, whether you're joining, whether you're ongoing, or whether you're leaving. So, first, this is very common: relief against total income. Relief against total income is there for ongoing partners as well, and also for partners leaving. So all the three situation, you can always relieve against total income. And how it works, I've explained in lecture 3 and 4 of my ATX. All you need to do is go to my lecture 3 and 4. You can get it from the playlist of my ATX lecture. At the end of this video, it's there. The link is given to my ATX lecture. Now, relieve against gains, chargeable gains, when you're joining. For ongoing partners also, this is there. And for partners leaving also, this is there. This is just like your exam revision, right? You can carry forward when a partner is joining. Ongoing partners can carry forward, but when partners are leaving, there is no point of carrying forward. You can't carry forward. And in addition, for partners joining only, opening your relief is there. But for ongoing and partner leaving, nothing is there. And for partners leaving, terminal loss relief is there. My previous lecture, lecture 4, I have explained terminal loss relief, how it works. Terminal loss means the loss of the last 12 months when you're trading. Okay. Now let us do a small question on this reliefs. Illustration 1. Partnership losses. So here you have three partners and Evie leaves the partnership, Maggie joins in her place, and they have made a tax adjusted trading losses of 20,000. State the loss relief available for each partner. So when we are talking about each partner, we will start from him, and Maggie, of course. Okay. So who is leaving? Always start with the partner who are leaving and joining. It's easier. So first we'll start with Evie. Evie left the partnership. For her, terminal loss relief will be there because she has ceased trading. Then we'll talk about Maggie. Maggie joined. So Maggie joined, opening year relief will be there. Of course, other reliefs are there against total income and against gains. But first we'll talk about the most prominent one. When we are leaving and when we are joining, what happens? When we are leaving, terminal loss. When we are starting, opening year. After that, we'll talk about Aino and Mary. They are continuing partners. Okay. Because they are continuing partners, they are not applicable for terminal or non-opening year relief. It's not applicable for them both. That's what it's explained in this line. Okay. So now whether they are leaving, whether they are coming, whether they are continuing, for all of the partners, relief against total income is applicable. Relief against chargeable gain is applicable if they want to, in the current or in the previous tax year. Remember, provided a claim against total income is made first. Always you have to make a claim against income first. Total income first before gains. This I've explained in lecture 3 and 4 properly. That's why you need to watch my 3 and 4. How all the types of relief, how it works has been explained. Now, all the partners except him can be, they are entitled to carry forward relief. Why? Evie is leaving the partnership. That's why. So now we are moving on to limited liability partnership. This is a special type of partnership, okay, where each partner liabilities are limited. Just like how companies' liabilities are limited, same. Okay. Taxation implications of LLP are like this. It is generally taxed in the same way as for normal partnerships. That means the partnerships which are not limited liability. And normal loss reliefs are available for them. So there is nothing new from the point of taxation, whether you are LLP or just a partnership. Now, what is the basis of assessment to CGT on partnership gains? We have finished the partnership income. Now we are moving on to gains. Partnership capital gain tax. So each partner will be having a fractional share of the partnership asset. So that means they will be accounted separately to CGT according to their own personal circumstances. Some of them might purchase, some of them might dispose. Okay. Now, this fractional share will be determined based on the agreed capital profit sharing ratio. Capital profit sharing ratio. Okay. This is different to your trading profit sharing ratio. This ratio is taken as from PSR, profit sharing ratio. Exactly the same way, the profit sharing ratio that you have used to allocate your balance of profit for income tax purpose, you use that only for CGT also. Unless the agreement says otherwise, unless they say that for CGT there are different ratios. Now, each partner will have his share of the partnership gain. They will compute their own CGT computation along with the gains from the disposal of other assets. They might dispose other assets. And if the entire partnership share is being disposed, what happens? It's possible, like how we have seized our unincorporated business, how we have seized the sole trader. Even partnership also we could entirely seize by disposing the entire partnership share. What happens that time? Then you can claim a relief that I've explained in my lecture 4, previous lecture, business asset disposal relief. If you are selling your sole trader or partnership entirely, you can claim a business asset disposal relief, provided a condition is met. What is the condition? You have to own the partnership business for at least 2 years before the disposal. This is the same for sole trader also. And you can deduct annual exempt amount of 6,000. Annual exempt amount in CGT is normally 3,000 for this tax year, 3,000 brought forward from the previous year. So it's 6,000. AE is always 6,000. Okay. So deduct AE of 6,000 against your chargeable gain, like how you have done for individual in the normal way. Then calculate CGT at 10 or 20%, depending on the basic rate band. Now, CGT reliefs. Rolled over relief is there, gift holdover relief is there. All these two types of reliefs I've explained in my lecture 4, where when you are seizing the trade. Same for partnership also. But this I will be explaining in detail when I touch capital gain tax. Now I'm still under income tax. I've not finished it yet. Okay. And remember, all partnership assets are business assets. Because partnership assets are business assets, that's why we are getting this relief. For rollover relief or gift holdover relief or business asset disposal relief, you have to dispose a business asset. Otherwise, you will not get the relief. Okay. Remember, rolled over relief and gift holdover relief, each partner can decide independently whether they want to claim this relief or not. It's not automatic. If you don't want, don't claim. And if a partner decides to make a rolled over relief, the partner's share of the gain is rolled over. That means it's deferred. It will be taxed later at the subsequent disposal, not now. And then that gain will be deducted from the cost of the asset, of the replacement asset. Now, when you're disposing a partnership to a third party, what happens? Strictly, each partner should have a separate capital gain tax computation for each partnership disposal. A separate gain should be calculated allocating the sale proceed and the cost of the asset between the partners. However, it is usually acceptable to calculate the gain arising on the asset and then allocate this one figure between the partners. You can do both the way. Either allocate sale proceed and cost among the partners and calculate the gain of each, or calculate one gain. Deduct the cost from the sale proceed, get one gain. That gain you allocate among the partners based on the profit sharing ratio. Okay. Now, before I move on to the summary, let us do one final question of this lecture. Test your understanding 3. So here, Paula and Bill, two partners are there. Paula and Bill. Capital is 30,000 of Paula, Bill 20,000. Ratios are shared 60-40. 60 for Paula, 40 for Bill. They have purchased a freehold premises of 125, and in September they sold the premises for 495. Now you need to calculate the chargeable gain for both. Okay, so we'll divide the sale proceed. We'll see by both the methods. We'll divide the sale proceed first between the two partners in the 60-40 ratio. Okay, what is the sale proceed? 495. So 60% will be 297. This is Paula, Bill. Total 495,000. So 60, 297,000. 297,000, and 40% would be 198,000. Now cost also 60-40. What is the cost? 125,000. 60 would be 75,000, and 40 would be 50,000. So now 222,000. This is the gain, chargeable gain. 222,000 and 148,000. 370,000 is the total gain from both the partners. Now, so this is your chargeable gain. Question asked you chargeable gain. Don't calculate CGT. Don't waste time. You are not going to get extra marks. Only this two is required. There is another way. You get this figure and this you divide 60%, 40%. You will still get the same figure. This also you can do. See, in the exam, it depends on the marks. If you are given more marks, try to do this format. And if it's less mark, then take one figure and divide it 60-40. Okay. Now, here you are just individually selling this one premise. You are not selling the entire partnership. That's why you are not getting any relief. You are not going to be eligible for business asset disposal relief. Okay. So now let us summarize this lecture. Partnership. Each partner is taxed separately on their share of income and gains. Each partner is responsible for paying their own income tax, NIC and CGT. Now, from the point of income tax, we went through trading profit. Okay, trading profit, it is adjusted normally how we do for sole trader, and capital allowances also are calculated and deduct from the tax adjusted trading profit. Profit and losses are allocated between partners according to profit sharing ratio in an accounting period. Apply basis of assessment rule in the normal way. Assessed as trading income in each partner's income tax computation. What type of income is this? It is trading income, and income tax will be charged on it. If applicable, loss relief options are there. When you are changing the profit sharing ratio, you have to time apportion the profit allocation and apply the profit sharing ratio for each part separately. We have done questions on it. When partner is leaving, joining, and continuing partners. Trading losses. Calculate tax adjusted trading loss in the same way as for profit. Loss relief options. Look, what are the loss relief options? When you're leaving, terminal loss. When you're starting, opening your relief. And when you're continuing, against gain, total income. This is same as for sole trader. Now, capital gain tax for all partners. They are deemed to have a fractional share on that gain. Okay, on that partnership asset. So fractional asset is the same as the profit sharing ratio. And they are taxed in their own right on their share of partnership gains. Annual exempt amount 6,000 and CGT reliefs are available in the normal way. For example, you might have rolled over relief or gift holdover relief responsible for paying their own CGT. Disposal to a third party. Calculate normal gain and allocate the gain between the partners. So that's it for this lecture. Thank you for watching, and I shall see you in the next lecture. The next lecture will be on property and investment income. So with this, we have finished the sole trader income and the partnership. That is also another form of non-savings income. Thank you for watching, and don't forget to subscribe to my channel and do watch all the lectures under my ATX playlist. Thank you.